The Bank of Japan surprised the markets on December 20th by doubling its cap on the 10-year Japanese government bond, JGBs, from 25 basis points to 50 basis points. Since 2016, the BOJ had prevented the yield on 10-year JGBs from rising above 25 basis points by creating money and using it to buy those bonds anytime their yield threatened to move above that level. The BOJ calls this process yield curve control. For 6 years after the introduction of yield curve control, investors who bet that the BOJ would be forced to allow the yield on JGBs to rise above 25 basis points lost a great deal of money in a trade that became known as the Widowmaker. But on December 20th, that bet finally paid off. The question now is, was this a one-off adjustment or the beginning of an interest rate tightening cycle that will see Japanese interest rates move significantly higher? This is an important question because rising interest rates in Japan would further tighten global monetary conditions with negative consequences for numerous asset classes. Higher Japanese interest rates could also unnerve financial markets by bankrupting numerous speculators who depend on borrowing cheaply in Japan to fund highly leveraged investments. In this video, MacroWatch will provide background information on the state of Japan's economy and on Japanese monetary policy in the attempt to shed some light on what may happen next. Japan's bubble economy popped in the early 1990s. Since then, economic growth has been very slow. Between 1992 and 2021, real GDP grew by just 20%. In nominal terms, Japan's GDP has grown by even less, by just 7% since 1992. Nominal GDP grew less than real GDP because Japan has experienced so much deflation in recent decades. Up until 2022, the highest rates of inflation in Japan since 1992 were the result of sharp increase